Okay, good evening, ladies and gentlemen. This is Clueless 8 Frank. This is a free market update webinar for a Monday, May 16th, 2016. Thank you for attending. This webinar, this free market webinar will be uploaded on the YouTube Clueless 8 Trading YouTube channel for review and for others who are not able to attend at this time. Full disclosure, this is purely for financial education and not for any solicitation or advice. We have KJS and Susie in attendance tonight. And let me just kick off. Let me get straight to the point. As a couple of very, very important observations, as I normally do, and these are very critical to the markets that we're going through right now, and as we have been going through for the past couple of months, if not for the last couple of weeks. First of all, we are dealing with algo, that's algorithmic high-frequency trading, machine-driven markets, which are implementing and executing rapid-fire, fast-moving, rapid-fire, high-frequency trades in between some structured levels in the market. What I try to do here at the Clueless 8 Trading Service, as you both know, and others know as well, that I try to identify the key inflection points where the markets will either have a reflex retracement bounce, in other words, they're going to bounce from a certain lower level, or they will have a reflex retracement pullback from specific levels that I can identify on the charts. When we review these charts and go over, and you also do it on your own time, hopefully, because that's going to help you with your trading and your success in your trading, you will notice that they are extremely mathematical in the points that are drawn, and that's the reason why when we look at these charts of the market in which we trade in, this being the S&P E-minis or the S&P 500 index futures, which are basically the backstage of the kabuki theater that we deal in, the actors being stocks, but the stocks are really puppets of the futures which are controlling the market back and forth. In simple English, a stock is up 8 points. Within 10 minutes, it can be down 4 points. There is no rhyme or reason. There is no fundamental reason. It's pure technical selling or buying, what we call liquidity pumps. When you get surges of money coming into the market in the form of high-powered, fast-moving algo HFT programs, it's a liquidity pump or dump. In other words, they're day trading the markets. The machines are day trading the market. I have been overall very successful in particular momentum trades, which are fast-moving trades, in identifying points where they will bounce from and points where they will sell off. The overall direction of the market, as you can clearly see from these lines that are drawn, you can see how precise they are. Of course, they don't look this precise in the middle of the war zone, which is the normal trading day. You can clearly see that what the machines are doing when we go back and review these charts at the end of the night or the end of the week or the end of the day or whatever it is. However, when you see volatility pumps up and down, as we can clearly see in the form of green candles and red candles and tails, such as this type of tails, reversal tails and things like that, which just suddenly happen from nowhere. Could be at 10 o'clock, could be at 12 o'clock, could be at 1 o'clock, could be at 3 o'clock. This one was the one that kicked off on Friday, the large reversal candle that kicked off on Friday afternoon. These cannot be identified sitting there, regardless of how smart somebody is, regardless how powerful their charting programs are. You cannot identify them at the beginning of the day or pre-market. You have to follow through what's going on during the day. And this is only one of the platforms that I use, as you all know. I use the Algo HFT charts known as Quad, QUODD. That's the platform. Highly recommended that people who are serious about making some serious money, which you can make on an intraday basis, case in point today. You have to be set up right the day before, which would be Friday, but you could still make some very decent money on trade alerts that went out today prior to the large rally kicking off. You have to use Thinkorswim, which is what we're looking at, and you have to have the additional tool known as Quad. Now, the reason I pushed that particular program, and I have no affiliation with Quad, just so you know that, and some of you have started using that, because they clearly identify, literally within minutes, when you start to see a liquidity pump, in other words, a move up, or a liquidity dump, which would be a red candle or a move down, within minutes, if not seconds, of it happening, and you can basically act on it. So it's highly recommended that if anyone is interested, that they should send me an email or contact me on PM on the chat room, and I'll be happy to send them that information. They can contact that company directly and move from there. But I have benefited tremendously when we get 100, 200% type of S&P moves on the options, both on the upside and the downside. I am relying primarily on the Quad platform in order to execute those trades. Okay. Now, what we're seeing in front of us, and let me continue with my observation. So what we're undergoing is intense volatility. Look what happened on Friday. On Friday, you got a massive dump right here, the 13th, which kicked off sometime in the afternoon, and the market basically started to come down. And if you just take this portion out, let's say we do this, 1 second. Okay, we do this. Okay, when you look at this particular chart, this is Friday. There is no way in the world you would think that it was a buyable event. Yet, if you review my posts and my trade alerts, I call selected buys, both on the S&P 500, the Russell 2000, as well as some specified stocks. Biggest stock in point is Apple, which generated almost 400% return between Friday and today on some specific calls that were recommended. Okay? Now, when you look at chart patterns like this, you get the general consensus out there, including StockTwits and other forums that you might follow, who are calling for the complete breakdown of the market. I am not going to get into extreme detail because this is a free market webinar update, so I can't keep on going for hours. If you're interested in understanding the finer details, highly suggest that you sign in for the advanced coaching sessions, which cost a few bucks, and I mean few bucks, but you learn a lot. And it's not about learning, it's about protecting your money and your profits. That's really what it's all about, making more money. So I'll leave it to that. Now, saying all that, if you looked at the pattern here on a Friday afternoon, this is Friday afternoon, I cut off today, you can clearly see here that this level was, from a so-called technical standpoint, was identifiable, which is 2020. Okay, but we never got there. We had a big fear in the markets about the Chinese data release was going to be terrible. And guess what? It was terrible. Every single metric that was reported, industrial production, capacity utilization, all the numbers that you could think of on the Chinese. Online, not online, Chinese consumer consumption, everything was down across the board. Exports, you name it, imports, everything. What did the market do? The market went up 200 and some points on our side, and even the Chinese markets were higher. If you review through my Twitter post, you can see that. Now, I'll go into the reason why that happened, because there is a specific reasons why that happened. Things just don't happen out of the blue. Okay, just remember that. Now, how you analyze and interpret the data and think outside the box, that takes skill, that takes knowledge, that takes a deep understanding about the game theory aspect of the probabilities of what might happen for a particular reason, what the outcomes could be, and I predicted those outcomes pretty accurately. That's the reason today was one of the most powerful days overall for quite a few traders and members within our community. Now, when you look at this chart pattern and you listen to all the gurus out there, they will all tell you the same story. This is a head and shoulder, and we're breaking down, and we're going to go to 2020. We're going to go down. We're probably going to test 2000. The probability of that happening was certainly there. I also showed very clearly that the channel lows are possible. However, I went with 3 distinctive out-of-the-box reasoning why I thought the market was going to bounce today. Number 1, the level and ferocity of selling, both on Wednesday and then on Friday, was large enough to create some very deep oversold conditions. Very, very deep oversold conditions, which are clearly shown, which I've said hundreds of times, simply by using the stochastics. So if you look at the stochastics here, we were down to close to the red line. We could have gone down below, and we can still go down below, but I'm just talking about today. So, but we were down here. There was also something called a positive divergence in play. Now, some of you are, what should I say, more experienced enough or are focused enough to see it, but let me show it to all of you. And this is not magic. These are observations that you can use to your benefit, to the point where your portfolio, your trading portfolio, can literally explode 20, 30, 40% in one single day on selective issues. Case in point, today. So let me show you what this positive divergence was all about. So here's a daily chart, and I am going to highlight the bottom from 1800, okay, to what's going on now. If somebody who had no idea about the stock market looked at this chart, believe me, they would be better technical analysts than the majority of the pundits and the gurus out there, because this chart is still clearly in an uptrend. It is not in an uptrend unless the E-minis or the index futures break below 214, and that translates into 2020 on the S&P 500. But for now, you can clearly see that's an uptrend. It's going from here to there, and it's going higher. Now, what is this positive divergence all about that I identified caused me, one of the reasons which caused me to go and keep long positions overnight? Other than the sentiment theory that almost 99% of the commentary coming out of the media, out of other forums, including StockTwits and other places, and very smart people out there, mind you. Okay, a lot smarter than me. But maybe they don't think outside the box. Remember, there's an old saying, Oscar Wilde once said that, there are way too many educated derelicts in the world. You could have a PhD in technical analysis and still be completely incorrect. That is the case with most of the hedge funds right now, most of the institutional funds who are underinvested in the markets. A significant amount of Wall Street analysts who have called the market completely wrong, both on the upside and the downside, and now turning heavily bearish. So I rest my case. And they have enough degrees to fill the wall over and over again. I simply have a bachelor's and an MBA. Those guys might have double MBAs and a double PhD, but as in their forecasting abilities, it's a big question mark. So it's not just the knowledge, it's our thinking outside the box, analyzing a lot of macro global economic news that's coming out, which I'll get into in a few minutes, which I could see that today was going to be an up day. Now, saying all that, this is what I'm talking about when I'm talking about the positive divergence. We hit a low on on the 5th of May. You can see that here, right? You can see that 5th of May. I guess it doesn't go below right there. Okay, so I'm going to leave it right there and draw it. Oops, sorry. Bear with me 1 second. I'm going to do a time level. Okay. Okay, so there's a time level. All right, right there. So here's a nice time level. So on the 5th of May, we were at 2039 or so. Look on the right side on the E-minis. Look where we went down on the stochastics. Deep oversold. From that point again was a powerful bounce that took us from high exeta. That took us from that 2039 level up to almost the 20, excuse me. Bear with me 1 second. It took us to 2081. Very powerful rally. 3 days. We took advantage of that. And then came a 3-day move down. Remember, it's a 3-day situation going on here. 1, 2, 3, and then 1, 2, 3. 3-day move down with 1 day kind of halfway in there, somewhat positive. But let me focus on this here. So we hit this extreme low levels on the stochastics. Powerful bounce from here. We got up towards 74. And then comes the 11th. We couldn't make it up here in overbought territory, and we went down. Then on Friday, we got down to pretty much the same. We actually went below 2039. Look on the right side. It's 2036. See that? 2036. Look on the right. Or 2037, whatever you call it. 2036. All right? But look where we were on the stochastics. Up here. So given the fact that we actually went below where we were on the 5th, shouldn't the stochastics be down here? Do you all understand what I'm talking about? I'm asking a question. KJS, do you understand what I'm talking about? Susie? Are you guys still there? Okay, I'll continue. So the bottom line is, given the fact that on
yes, sorry.
Yeah, that's fine.
Sorry, yes, I do understand.
Okay, because it's not rocket science, so I want people to understand this, because if this simple concept they can understand, they can just act on it themselves. So here you have 2036, here you have 2039. At 2039, the stochastics were at 9 down here. At 2036, which is below 2039, the stochastics were at 21. This is known as a positive divergence. So in other words, even though the price fell below the previous level, the underlying stows or the pressure of the selling told us that that the pressure was less than what it was here. So that's known as a positive divergence. You get a higher low on the stochastics with a lower low in prices. I repeat, you get a higher low in the internals with a lower low in the actual prices. That's why I keep on stressing every single day in the chat room. I've mentioned this on my Twitter feed to remind traders, do not always rely on prices. Prices itself, because of the manipulation of the machines, do not give you a clear indication of what is about to happen. Machines will drive down prices and drop things 10, 12 bucks for no reason other than a slew of factors like maybe some capitulation selling. That's when people panic and they sell. Maybe a couple of hedge funds having to dump stocks because of margin-related reasons. There is a good number of hedge funds, by the way, who were forced to sell stock on many different solid companies because they had redemptions, because their clients said enough is enough. And this happened with mutual funds too. Clients get freaked out. They call them up. They said, listen, I want to take my money out. Mutual funds have to deliver the money right away. Hedge funds have a window, sometimes 30 days, sometimes 3 months. Whichever the case, they have to liquidate position in order to keep money in their money market account. So a lot of forced, crazy selling happens during very freaky times. And that was the case last week. And it will be the case again, mind you. But what I'm trying to get at is that the pressure of the selling was less on Friday than it was the week before. So that was number one. Now, these things are not difficult to understand. You just have to think a little bit harder to understand the concept of what I'm talking about. And I don't make these things up. This is the reality of the thing. So what we got was a pattern which looked like that it was going to come down all the way to 2030, which I kept on saying. I did keep on saying that 2030 would be a level that we'd probably bounce off. We got close to it, but never there. Now this is on the E-minis and on the S&P E-minis, not on the actual S&P 500. Whichever the case, which I've said before, use the Darvas box, this magenta box you have there. Transpose the Darvas box on top of your charts. If you use Thinkorswim, which I think everyone should use, and then you would know that we were contained between these levels. 2030, 2094. If we broke that, it's a different story. Then certain lower level come into play, which I've talked about before in my video cast. That'll be 2020, possibly 2000 on the S&P 500. Whichever the case, this is the wave we're going through right now. Today was a large bullish candle, also known as a bullish engulfing, because the body of this candle is larger than the body of the candle on Friday. Does this mean it's going to follow through tomorrow? I have no idea. I can give you a probability of what's going to happen, but this candle could very well be a big fat red candle tomorrow when we wake up in the morning, which features down 15, 20 points, because that's the volatility and the volatile world that we live in. Volatility in itself is unquantifiable. You can't sit there, have a nice drink in your hand with a pencil and say, okay, here's the nature of volatility. Volatility is like humans losing their temper. All of a sudden, they're not thinking straight. That's volatility. Volatility messes with traders' brains. And that's the reason why you listen to all these guys on the media, you listen to all the great posts and charts and everything on StockTwits and other forums, and all they could talk about was how terrible Monday was going to be. And you have to monitor those things because, so you understand what the other side is talking about. Now, don't take me the wrong way. I'm not some raging bull here. I've shown clearly what the levels we could get to. We actually got to exactly that level. I said we would get to 2060, and then I said we would possibly test 2070. Guess what the S&P 500 did? Went to 2071.88, pulled back, and closed at 2066.66. It's all technical stuff, okay? So I'm neither a raging bull, and I'm certainly not a raging bear. Saying all that, we'll see what happens. Now, the other factor to keep in mind, which all of you have to really understand as to why this happened today the way it happened. It wasn't because Buffett bought Apple. I called Apple before I had any idea what Buffett was going to do on Friday because of technical charts. It's not because, Because honestly, David Tepper, who's one of the finest hedge fund managers out there, he dumped Apple last quarter because all these hedge fund filings are coming out right now, known as 13F filings out of these funds, right? He dumped Apple. So that's just side topic, what's going on. The real reason why today happened the way it happened, because Chinese numbers were very weak. Number one, everybody, all the smart money knew the Chinese numbers were going to be weak. So the element of surprise was gone. Don't forget one thing about the market. The market is a game of expectations, just the way humans. It's what you expect from somebody else. If you expect somebody to be a good person and they turn out to be really nasty, it hurts you a lot more than if you think the person is nasty and then they're nasty. You say, well, I kind of knew that. It's the same thing with the market. The market knows that there's bad news coming out, that this is going to be weak and this and that. Well, guess what? If it's less weaker than expected, the market just takes off and has a huge rally. To this day, individual investors and a lot of pros don't seem to understand that. The market doesn't move on exact news. It moves on expectations of what that news might be. And that's the reason why a lot of the times companies come out with earnings which are a little less bad than what they thought, and their stock rallies up 10%. And there's a lot of traders, including in our group and other groups, they sit there, scratch there and goes, well, the PE was that, this was that, then. And that's my big warning sign comes in. Stop being an analyst. Because the more you try to be an analyst, first of all, PE really doesn't matter in the real world. It's PEG. That's price earnings divided by growth rate. If a company is growing very fast, then the PE ratio is diluted and a lot smaller based on the PEG. That's just one simple measure. Then you look at free cash flow, you look at all kinds of other stuff. So please don't try to be an analyst. Keep your day job. And if you truly are an analyst, then you are a really, really crappy trader. Because most traders, 99% of analysts, in fact, all analysts are the worst traders ever. Traders are a different breed. They act based on contrarian thinking. They act based on technical patterns and the reaction of what the stock is doing after the news is delivered. Just remember that, all right? So the China news came out terrible. So that was expected. It wasn't like it was. In fact, the whisper number on the China news, from what I heard, was far worse. In fact, the smart money expected, or the so-called smart money expected, the China news to be terrible. But it was slightly lower than expected. That's number one. Number two, two things simultaneously happened. Oil went berserk. And if you look at the chart of oil, what happened overnight? It just basically went nuts. Okay? This was Friday. Sunday night. Look at oil at 46. Talk about a ramp. Big time. Okay? So that negated a major negative factor for the market to fall apart. Because if China was weak, you would think oil would go down. Oil supply is starting to come into balance. In other words, the capacity, the glut in oil out there is starting to shrink. Consumption is starting to rise, and oil is on a tear. On a technical level, I've showed this many, many times over months, oil is roughly going to $50. And guess what? Goldman Sachs comes out today and says oil is going to go to $50. Great geniuses. Before, a couple of weeks ago, they were saying oil is going to go to $20. Now they're saying oil is going to go to $50. And oil is going to go to $50. It doesn't take a rocket scientist to figure out because it's almost there. Second factor was oil. The third factor had to do with Japan. And I posted that on the Twitter feed. Japan's Abe, Shinzo Abe, decided that by the 10th or so, I believe, no, in the next week or so, he's going to eliminate the proposed sales tax increase, or the VAT, value-added taxes on consumers buying goods. And that's a great thing because he realizes the Japanese economy is slowing down, and he's not going to basically collapse his economy, despite the fact that every so-called guru on StockTwits and other forums are like, oh, the Japanese don't know what they're doing. No, they don't know what they're doing. That's why I remind everyone, please keep your day jobs and let the central bankers do what they need to do. And let's not try to overanalyze everything that the central banks and the politicians and stuff are trying to do. Because if we were that good in managing countries, we wouldn't be trading here, would we? We would be running a country. So obviously we're not doing that. So let's try to be humble and keep it to it. Okay. So the other thing that happened overnight was the Japanese, which I explained to everyone, the Japanese yen weakened substantially. Remember, this is an inverse chart of the Japanese yen. In other words, this is the Japanese yen versus the US dollar. So the higher the number goes, that means you're buying more yen. $1 US is buying a lot more yen. So from Sunday night, look what happened. I've explained this many times. I'll explain it very quickly. This is known as the carry trade. Okay, the carry trade. This is where global funds, hedge funds primarily, borrow cheap Japanese yen versus the US dollar. Remember, as the number goes higher, that means for every $1 you're buying more yen. As you can clearly see here, it's starting to creep up again. There was a little bit of a sell-off in the afternoon. So the carry trade was on. So this was a risk-on environment. What does risk-on mean? Explained this many times. Explain it again. Risk-on simply means the market is going to rally. Risk-off means the market is going to fall and money is going to go into government bonds and such in safe havens. Well, today was a risk-on day. So the fact that the Japanese yen started to rally, and I posted this too, was an indication that you were going to have a strong day. Whether or not we're going to have a 200+ point day, I had no idea. I know the technical levels we were going to go to. I did say we were going to go to about 2060, 2070. I said the market would find some major resistance, which I'll show in the next chart, around 2080 S&P. And we went to 2072. I didn't say 2080 was going to be today. I said this week. And just on a move of 20 S&P points, those calls which were proposed to people, even the lottos, went from $1 to $3.40. Do the math yourself, what that means. And this is just from Friday. So this brings me to my other point here. I hear a lot of excuses in this business. I give myself excuses. And you know what? That's the last thing you ever want to do. Stop giving yourself excuses. Act on what you see in front of you. If you're wrong, get out. But don't sit on the sidelines waiting for some, like saying some perfect moment when everything's going to be a green light and you say, oh yeah, everything's great. We're just going to buy the market right now. The only time to buy the market is in deep oversold conditions, which I have clearly identified several times. Some of you listen, most of you don't. Next point. This is your S&P 500 for you. Okay? This is a 15-minute chart. Let's go to the daily chart. The daily chart was deeply oversold on Friday. It was something I was watching very carefully. And I mentioned it. It's not that I just watch things. I work very hard to notify all of you to look at the same things. And then you decide what you want to do. Yes, there was a possibility we'd test the 2039 level. And yes, there was, and we got almost there. We went to 2042. And we could slip as low as 2030. All levels were identified. But I did say that this 50-day moving average, this red line here, and now we're talking about the real S&P 500, would be something that the market would be attracted to. It had to, somehow this market is strong enough to at least hold the 50-day moving average. And I kept on drawing something called the consolidation channel repeatedly. And I'm sure all of you remember that. this consolidation channel. I kept on showing it. Guess what? We held the consolidation channel. I'll go over this chart in a quick second. And we bounced. Today is this green candle right there. This was yesterday. There was a downtrend line drawn, and guess what we did? Yesterday at, trying to figure out the time, what was it, around like 12:30, 1 o'clock? It hit the downtrend channel, and it completely gave in. Because before that, we were going higher. Remember, we were going higher the first part of the day. And we started to, but again, I saw a positive divergence. And that positive divergence was the fact that this level here, sorry, 1 second. This level here on Friday was pretty much similar to this level here earlier in the week. Stochastics were far oversold earlier in the week. And on Friday, even though we came down to the same level, look where the stochastics were. That, ladies and gentlemen, is known as a positive divergence. Means the internals made a higher low versus the price making a similar low or a lower low. If you still don't understand it, feel free to ask me. If you don't want to ask me, just think about what I just said. We've seen multiple positive divergences in multiple fronts across the board of some very tactical bottoms. This was one. When we crashed in January of 2016, and this was a real crash, okay? We hit the markers right here. When up here, when the market was a little bit higher, we actually hit a lower low. There was a minor positive divergence here. But the real positive divergence came when we made the second low, which was back in that 1800 level. But look where the stochastics were. They were higher. So that again is a positive divergence. Simple things you can do. Look, I'm not a pundit, okay? I'm not somebody who's going to teach you about a wave 1, 2, 3, minor subjugation and this and that and great stuff that some of these guys know about. Let them be rocket scientists. My direct hit ratios in any day is going to be better than them. But let them analyze the waves to the point that, you know, they want to work at NASA. That's fine. My job is to keep it almost as simple as possible within reason. So this is one of the simplest ways that I've seen over the years that you can actually make a lot of money. Now, this doesn't mean that you're not scared. It's not, was I not scared? I mean, was I not worried on Saturday when I see the Chinese numbers coming out? Did I freak out and order a diaper from Amazon? You know, that's the joke for really freaking out, right? Panic. No. I held my breath. I looked at all the other stuff coming out. Japan, what they did. Removing the possibility of implementing the sales tax, looked at what oil was doing, and I felt a sigh of relief. I also noticed on Sunday evening, and that's the reason why we didn't have an end of the week report, because there's a lot of stuff going on. I was monitoring it. On Sunday evening, I noticed futures were down 6. Futures should have been down 20 points on the Chinese news, but that wasn't the case. That was another tell. This market was going to find a footing. But there was no guarantee. We could be down. We could have been down 30 S&P points at the open. But at least I knew what levels I was dealing with. I knew we would have very strong support base between 2025 and 2034. I had some cash on the side. I always have cash on the side. To act to that, I knew that this pattern here would at least have a tactical bounce, which it did. Even if we slipped a little bit lower, touched the bottom end of this channel, and all this is drawn not just for my benefit. I know what these levels are. It is for all your benefit. What I'm doing tonight, what I do every single day, honestly speaking, is not for my benefit specifically. I'm actually doing it for your benefit. So again, stop giving yourself bogus excuses that you can't make money. The only reason you can't make money is because you don't act on situations, whether on the long side or the short side. Market's up 200 points. How many times did I warn today? large profits, take partial profits, do not carry large overnight position, and I'm right. So even if the futures are up 7 points tomorrow, who cares? You protected your profits. Yes, you let go of a little bit. We'll determine tomorrow what happens. That's what tactical trading is all about. It's not about being a baby and getting all excited when we're up 200 points and overbought on short-term levels. Even though on the daily, as you can clearly see here, it still looks like the daily wants to climb up towards this overbought zone again. I don't know whether that's going to happen. It's very possible we hit the upper end of this channel right there, which is right there, like 2080, like maybe another 60 points or so on the Dow, and then collapse again. It did it last couple of times. So why can't it do it again? Who's to say we're going to break out of this channel, this consolidation channel, right, and hit the upper end of the range around 2100? There is absolutely nothing that says it can happen. Unless somebody is a blind bull, which is fine. They might be right. It's possible that we break out of these two, this blue channel that I've posted many times over 2080 and make a rush towards the gate, towards 2120. Now, I did say there's some seasonal factors. The monthly OPEX is this Friday. And generally speaking, the monthly OPEX expiry is a bullish event. Given some of the factors that are in play right now, such as the biggest stock that has been creamed out of Kingdom, but now starting to rise and up 4% today, almost Apple. When was the last time we saw that happen? Okay. So it's possible that we break out up towards that level. No idea. All I know is that we are getting close to this channel here, and this particular daily, this is the daily stochastics, are still showing that they seem to have a rounded bottom. So if they keep on continuing, even though if the market pulls back a little bit, doesn't matter. It really doesn't matter. If these stochastics continue to move higher, you stick with the trade. I have said this many, many times. I'm saying it again. So learn for once. Now, is it going to be easy? Absolutely not. The easy money was made today. Now, are there selective positions that money can be made? Absolutely. I've put some great ideas on the table. Stocks which are well below their 52-week highs, which still can be taken advantage of. You don't have to always chase Amazon. There was nobody in sight to buy Amazon in the 600s. I still remember that. Not a lot of you included. So some of you now are like getting all excited about Amazon at 7-Eleven. Great. Get excited about stocks which have fallen and technically buyable, such as Apple, which I really don't care about. But technically, it was a screaming buy. That's why it screamed and said buy on Friday. High risk, but at the same time, low risk, high reward, given the technical factors. VRX, Regeneron, off the lows, AGN, and a bunch of others that I've highlighted. Remember, I don't tell you to go out there and buy everything. I'm not telling you to go buy Google now. I'm not pushing Priceline, even though I called it right, and I still think it goes to 1300. Start thinking, okay? Start thinking. If you want to survive in this business and do well and tell yourself, because this business, the biggest competition is not the market. It is not the other trader. It is you. That's what I keep on telling myself. My biggest competition is me. And I make I make not big fundamental mistakes, but I still make mistakes. The volatility and the insane volatility where things are looking just right and then the breakdown, it causes me losses too. But resilience, understanding, discipline pays the bills. Case in point today. Now, this can happen both on the long side and the short side. Look, if I thought this market was going to go to completely melt down, and I could technically convince myself it would, why wouldn't I go out there and buy a huge amount of S&P puts and Russell puts This is another huge winner. And just stick there, because my discipline of understanding technical analysis basically told me that we were hitting a tradable short-term bottom. A tradable bottom simply means a bottom that can be traded on the upside. And I couldn't bring myself to really buying, other than a few hedges on the UVXY and stuff, to really going out there and going really crazy short, like many out there seem to do. And the amount of pain that they suffered today and in other days like this type of tradable, huge reflex bounce happen is unbearable. But they won't tell you that. Everyone wants to get instant gratification. I do too. When it's trading, I want to see this breakdown that you're talking, that we see here, to completely break down and go all the way down, test the 200-day moving average, all in one day. I want this to happen in 4 hours so my puts can go up 900%. It doesn't happen like that. The markets know very well that everyone's crowded into one room. That's why they do what they do. Those are the patterns I try to determine for all of you. This type of falling wedge, or a consolidation wedge if you want to call it, this is where we are. Does it mean that it's going to break out? No idea. It might very well come down here, keep on doing this, and then break out. Generally, a falling wedge breaks out to the upside, but it can also break down to the downside. And the next level of support, which I've shown clearly, is that 1085 level, and we'll see when we get there. But the markets are not that easy to crack because the world is not ending. Just remember that. It could do this and then make a big move up. Again, another positive divergence on the Russell 2000. I have multiple charts that I've showed this in, so I'm not going to waste my time showing you guys the same thing over and over again. So sentiment is extremely poor, negative, and this is the other thing that I wanted to get into. This market has really, excuse my French, no, I'm not going to say the word. Okay, this market has really screwed up people's brains big time. And you think you're the only one? You're talking about billion-dollar players on the hedge fund side. They can't deal with this market. They've literally packed shop. Now, their sizes are bigger. Obviously, they're dealing with billions of dollars. They can move in uber volatile markets. So what this market has done, and take a good look at this chart, okay? This is a rising wedge and a consolidation channel. That's your SPY. This red line is the downtrend line, and we close slightly above the downtrend line. Every single point that you see on this chart means something. Another thing to keep in mind, I just want to mention this, is if you notice where we are with the 30 and the 50-day moving average, they're still kind of moving higher, if you notice. Look at that. Now, some people might squint their eye and say, hey, they're starting to really bend a little bit. Well, yeah, okay. If we get if we keep on getting more thumbs down, these two lines will bend down. And you will get a correction down in the 200 level on the SPY. And you will get a correction possibly to 1950, 1960 in the S&P, or 195, 196 on the SPYs. And that's still there. Why is this level important? Because this was the level from this dragon bullish pattern that the market broke out back in February. Back in February. Okay, so is it possible that it comes down and tests this? Absolutely. And that's a big drop. That's a big drop, ladies and gentlemen. You're talking about 700 points from where we are right now. In other words, we go straight down to 17,000. So 17,000 Dow is right here. And 18,000 Dow is right around here. So it looks like we're trading in a very large band. Actually, we're not trading in a 17,000 to 18,000 band. We're actually trading between 17,500 to 18,000. So these are the levels, okay? If you want to just keep it simple. You want to sing a little lullaby to your baby? You say 18,000 is where Santa comes. 17,500 where Santa is very confused. And so are every trader, scared. And 17,000 when everyone just gives up on stocks. And that is a tremendous level to buy things for a powerful bounce. So what we did, we went to 17,500 roughly, and we bounced. It's really as simple as that, okay? Now, going back to what I was talking about, the head, because that's all that it's all about. It really is all about the head. This volatility and this intense movements, which I have structured, shown, given the probabilities of what might happen, what might not happen. Not right every 5 minutes. I can't. I didn't know Friday was going to sell off like from 2 o'clock. Still had a great day on Friday. Powerful day. So many stocks that we had worked. And we started to nibble. So we're down a little bit on the last ones that we bought. But what happened today? You got heavily rewarded. So the point is, when these type of big volatility patterns happen, let me clear this out. Okay, these type of, and it's moving within a band, mind you, okay? But it's not fun when it's happening during the day. This is what happens. Everyone shuts down. Look at yourself. Many of you shut down. I see very low participation in the chat room. That's the first contrarian indication that the market is starting to create a tradable bottom. Look at this session that we're doing. By the way, who is Pincher who just walked in? Pincher, can you identify yourself, please? Bear with me 1 second, guys. Pincher, can you identify yourself, please? Pincher, last call for alcohol. Can you identify yourself, please? Okay. Pincher, can you hear me? Okay. I don't like strangers in the house. Pincher, can you hear me? Interesting. Okay, let me just waste time. All right, Pincher, identify yourself in the next couple of minutes or else I'll have to boot you out, okay? Standard procedure. All right, so when this type of stuff is happening, your head is totally messed up. There's a lot of signals to read, but I'm making it simple by constantly putting through on the Twitter feed, constantly walking through people on, bear with me 1 second. One second, please. Oh, hi, Randy. Okay, sounds good. So Pincher is good. All right, so constantly all day long, I'm showing these type of charts. These arrows simply meant positive divergence, and I purposely left it alone because I can't keep on writing all the things here. This is not, some people say I'm here to learn, and obviously everyone's here to learn, but I'm not an online learning academy here. I mean, to be honest with all of you, my service is really to, the interactive part of my service is not mandatory. My service is to give you charts and tactical trade alerts. After that, it's all on your own. But I tend to be involved quite a bit, which is almost babysitting times 5. So here's another chart, consolidation channel. what's going on a different platform. I wrote this down. If you do not understand this algo HFT chart, you've not made any dollars. And I mean that. You need help to become a successful trader or investor. And I said, sign up for the advanced coaching session. This advanced coaching session is not going to pay my debts, my bills, or make me rich. It's going to make you rich, in my opinion, or richer than you are right now, and hopefully make you lose less. Anyway, this is a very tactical chart. Parallel channels, what's going on? We are overbought. We have a red candle right at the end of the day. Told people, take profits off the table. Keep a little bit on the table. Swing trades are intact. But if you're trading the high momentum stocks, you better take your profits off the table. Right there, that red candle is telling me that the sellers are coming in and we're overbought on the 1 hour chart. And many other different. This is a gap. The dotted lines are a gap right there. Every single line here is talking to me. So it should be able to talk to a certain degree where you need to interpret that. Here's another very tactical one. So while I'm showing you all this, what I was getting at was the average trader's brain, and sometimes it happens to me too, okay, is mush right now. We have very low participation. Everyone's scared shit, excuse my French, even though huge opportunities are being laid down. Not just today. Every day, even on bad days, we have had big winners. On Friday, we had Shake Shack. Shack was a big winner. What was the other one? We had AGN, Allergan, up $8. Whole slew of other stocks were up nicely. And you can scroll through the Twitter feed to see that. Not a lot, but some powerful movers. So when your brain becomes mush, you act like an idiot. What does an idiot do? Sits there under a tree just looking blankly out. That's what traders are doing, in my opinion. So what is eventually it's going to do? It's going to eat your brain out to the point where you say, I cannot do this, see you later. And then you see the markets go up or down, and these technical alerts would have made thousands and thousands and thousands of dollars back, which you never participated in because you sat under a tree and stared out blank. So this is the reality of the business, what I'm saying. When you feel the crappiest is the point where you have to work the hardest. I say that to myself. I say that to my son. And I'm saying it to all of you. But I'm not Dr. Phil. And I'm not, Tony Robbins. I'm just giving you the practical reality of what happens in this business. So when you see volatility big time, okay, to me, this is the pattern. What's going on here? You have a head, you have a shoulder here. Now you're back here. You're in this trading range. I put that in a box. I don't know how much easier this can be. This is the box we're trading in, 2040 to 2088, 2090 on the upside. We break out of the box, we're going to go to 2100. We break below the box, we're going to 2020. It's really as simple as that. Now, does that mean that you know exactly what's going to happen intraday? No. Sometimes you go short and the market goes up 50 points against you. You're sitting there going, why? But if you're tracking the charts closely, you're seeing that it's getting overbought here on the hourly, you know what to do. And not just that, it's not that I leave you guys all alone. I work with you constantly during the day. Even sometimes when I don't want to work with you constantly because it's busy. I have to manage my own trades. But I'm still posting. That's my responsibility. That's my job. And I'm putting out some very powerful charts, which you will have to know how to read. It's like giving you a great novel, but you don't know how to read. So you're not getting the message. If you really want to understand how to read, sit in these coaching sessions, not just the free ones. Pay a little bit for the time, come into the weekend sessions, and really get into it. It'll pay back in bundles. Anyway, so when this type of volatility is going on, this is just like wild, okay? But there's a pattern. You can see the pattern, but the pattern is not a smooth one. It's not like a bell curve, right? It's like zigzag, even, So your brain becomes mush, and it don't do anything. So good luck. Now, Saying all that, given where we are right now with the market, I don't know if we're going to get up to 2090. We might hit this block here and go straight down. Believe me, it can happen. Why? Because it's happened so many times. It's also possible, that's why I drew this line here with the sell red arrow, that we could get to 2090. And if we break 2090, it's going to be a fast move up, not here, up to, again, this resistance level here, which is around 2100. And then we might pull back and do this move before we go higher. So it's possible we pull back another 200 points and then make a move higher. That is pattern symmetry. But we can sit here and predict all that stuff. But I believe, and I repeat again, I've always said this, that middle of the month, the 15th, give or take a couple of days, is when the biggest turbulence hit the market. We are going through it. Today was turbulence on the upside. We had big turbulence on the downside. 3 weeks in a row we were down on Friday. But I believe that given my experience, given the actual stats on the ground, that Friday's option expiry going into Friday will be a positive event. It doesn't mean we won't have a blood red Wednesday. If we get a major move up yesterday, I can bet you, obviously I bet, that's what I do for a living. Hopefully you guys do too. In trading, you're betting probabilities that we're going to have a pullback on Wednesday. Saying all that, great chart of Apple. Should frigging post this on your wall as a poster. Okay, here's your gap fill, the box. Here's the breakout out of the falling wedge. Now, is it going to be as simple as just buying it and it's going to go straight up there? No, it'll probably zigzag a little bit. And if Apple comes down to 88 again, it could either create a double bottom, which would be extremely powerful. Let's say Apple goes from 94 and falls to 88. The first thing you're going to hear is the primal scream of the monkeys and chimpanzees, right? Like, it's over, Apple's finished, that was all a big hoax. Nothing. It would be a double bottom where the move would be extra powerful, moving higher. Is it going to do that? I don't know. All I know is that at least looking at the trajectory of what's happening right now, Apple wants to at least get up towards that 96, 97 level, test the lower end of the gap where it fell from. This was a big, this was the drop in the lower gap, and then it kept on continuing down. And I gave you the probabilities of that happening. This is still negative. The 50 has crossed over the 34. The 34-day moving average has crossed over the 50-day moving average. The yellow line is below the red line. That's a negative. No question about it. Is it possible that it at least goes and tests that level before it fails again? Absolutely. In reality, you want these lines to continue up, not cross over down. Now, is it possible that Apple makes a surge towards 109? And believe me, anything can happen. And some of the stuff that's happening underneath Apple is extremely positive. I don't want to get into it right now, including the fact that Tim Cook is in China, next visit is India, what he's doing with this $1 billion investment in Didi, the Uber of China, that is supposedly going to go public next year. I posted that in the US in 2017. Imagine how much money Apple's going to make off that IPO. So a lot of other things are going on. Bottom line is it possible that Apple makes a big surge and these lines, instead of pointing down, start to turn up? Absolutely. We can sit here and predict that. We'll have to see. I'll notice the internals, which are just starting to turn. You can see that clearly. These internals were like this before, back in, when was that? April. April? No, March. In March. March, April, May. Yes, March. Sorry, February. What am I talking about? This was February. So when Apple was bottoming, pretty much the same levels, very clear. Look what the stochastics were doing. And then it just surged. Exactly what it's doing right now. What happened to the stock? the stock started running like a monster. So whichever the case, I don't think Apple's going to go back to 118. I have no idea. It can test the downtrend line, but at least it can get up towards the 100 level, triple digit, simple. Apple wants 100. How about that? Do you know what your returns on Apple calls are cheap? If on a $3.46 move, or when it was at 94, on a $4 move, the calls can go to 1 to 4. Imagine what the calls can go when it goes from 96 to 100. But we'll see. The bigger picture says, is it possible Apple does this? Sure it can. Everyone wants it in one day. It's not going to happen in one day. Is it possible Apple does a double bottom and takes a reverse course to 88? Possibly slips a little bit because everyone panics big time and then makes a move up? Absolutely. All I know, the internals are pointing up, and based on pattern symmetry, based on what happened in February, the chances of it moving higher are better than the chances of it moving lower. So that's another great chart that I posted. Running out of breath. Okay. These charts that I post, these I do directly off my iPhone. Valiant. It would be a rocket scientist to figure this out. You can see the stock is in a very pinched Bollinger. This looks like a sphincter. Anyone knows what a sphincter is? If you studied biology and still remember that? I know somebody here who knows it. So it looks like a gallbladder, right? So a pinched Bollinger means there's an outsized move coming. This was a pinch Bollinger, and the outside move was the stock fell from 30 down to 26. Now it's moving up. What do I think it's going to land up? I've shown enough technical charts. I'm showing you a quick, easy one. The stock probably gets to 40. Again, it's not rocket science. Now, is it possible it just makes a big move down? Yeah, but it's a low probability. Enough things have been thrown at Valiant right now, and one of the reasons why I bought the stock, besides, it wasn't Citron, it wasn't the short seller, Andrew left. It had to do with the fact that Elijah Cummings, who's one of the toughest critics of Valiant, he's a senator, congressman or senator, said that Valiant's making progress. It's like your biggest nemesis in Washington, D.C. and Capitol Hill is saying, you know what, looks like you guys are making some improvement. Think outside the box. That's a big plus, that they're not going to go over and slice them inside out like they did before. Then there's the daily technical charts. You can see that what's going on. This small candle itself was good enough for a 45% bump up on the options. Just this little candle. This is a shorter term picture, 29 bucks. These patterns are very defined, as you can clearly see. And then I put these structures on top of it so all of you guys can benefit and not just look at the chart. Look, I can show you charts and you guys have no idea how to read it, guaranteed. But once you put a structure on it, it makes it easier to read it. Here's another new position that I pulled in, which is Delta Airlines. There was a fundamental basis on why I bought it. Delta is doing some positive changes within the company. Customer satisfaction included, passenger satisfaction, low flight delays, flight times on time. They're making more money. This one is a defined trade. You got a low at 40.20, and this is where we are breaking out from. It breaks out 43. It's going to go to 46 and complete this pattern. Will it go all the way up here? I have no idea. All I know, it's going to engage the 34 and the 50, and for 60, 70 cent calls, that's a big move coming up. You probably sell them at $3. SPY consolidation channel again, showing you clearly. Look where the turning points are. Very similar to what I saw here at the bottom of the market at 1800. Now that's a huge positive divergence. And I hope by now you guys figure what I'm saying. We got down to the same horrific oversold levels, except at that time we were at 1800. And this time we came down and tested the 50-day moving average and the lower end of the consolidation channel at 203. So 180 and 203. We're up here, but we got this deeply oversold. In other words, the chances of a move up now that as it's unfolding are pretty damn good that this consolidation channel is going to hit the mark at 2090, if not 2100. Based on this, as long as this starts to continues higher. If this starts to come down again, that's another buying opportunity. But again, the market will basically be another ugly red candle testing 203 and possibly breaking down to 202.50. And this will be a red candle. Is it possible? Absolutely. But we have to keep on watching the internals. Because if the internals are curling down, that means that consolidation is not going to break out. It's going to hit the top and it's going to pull back. I'll be there to alert people. But a lot of mixed signals, but I'll still alert people what I see, and then they can take it from where they go. Retest possible breakout. I said 2074. What time did I say that? At 2:13 p.m. Where did we go to? We went to 2071.88. It's pretty precise. CMG, why did I call it a trade? I've called it right almost every time. Because I saw this reversal candle. This is what the Algo HFT platform show me. Define. Yes, it could slip to 434. I put a line up there. I would be a buyer at 434. But I bought it here. And it went up 3 points from there by the close. Went up a little bit higher and ended up 2.5 points. Pretty damn good. Look at this. Starting to curl. I'm not saying it's going all the way back to 470. All I simply said was it's possible. This was the channel the stock was trading in before it broke down. So I believe that it can go to 450. You buy lottos at 1, sell them at 4. You know what the problem is? I'll tell you what the problem is. We're showing some pretty fantastic returns. You guys are not taking advantage of it. And you think it's just normal daily stuff that you can make 100% just like that. You can, if you take the right measure at a very difficult at difficult times, and those are those oversold zones. You don't take them, you chase them. I see this happen all the time, and it's pretty pathetic if you ask me. I see people chasing. Why do you chase price? Chase technicals when they're saying chase me. Don't chase price just for the sake of chasing price, because you will get burned. That's the type of market this is. And you can clearly see that over and over again. Don't just chase price. And I've said that to everyone. There are a lot of good traders who just chase price. And they can do okay, but they get hit a lot harder in these type of markets than they've ever been. They won't tell you, but they do. Here's a chart of oil. I drew this channel weeks ago, and they're pretty much following it. That's another proxy you got to follow. Oil is now getting overbought. If oil pulls back $2, this market will be down 150 points, just like that. Another powerful chart about the 10-year Treasury yield when it gets down to these horrific levels of 1.7% or so. Not 1706. It's the decimal point. You got to move to the left. I hope you guys know that by now. Okay, so 1.77%. You have a major move up on the market now. Very, very important. I've covered this before. I'll cover it again. Right now, the dividend yield on the S&P 500, on the average dividend yield that you can get on S&P 500 stocks is roughly 2.2%. That's on the SPX. The 10-year government bond yield, which is known as the safe haven, what do you call the safety trade, right? Was delivering to you on Friday 1.7%, and currently at the close of today, this was on Friday, 1.7%, and today it closed at 1.753%. If you were given a choice with your money to make 2.2% or 1.7%, which way would you go? The answer is simple. I don't need an answer. You would go towards where you're getting a higher yield or rate. So you're getting a higher yield buying stocks at 2.2% with the potential that stock prices can go higher. So 2.2% minus 1.75 is a difference of almost 45 basis points. So 1 second, let me just tell you something. So let me ask a question and please give me an answer if you can. What is the percentage difference between 1.75% and 2.2%? Please. Can somebody tell me? We don't have all night, so please tell me.
About 25%?
Thank you. Kartik, that's you?
Yeah.
Yeah.
Yes.
Yeah, exactly. It's 25.7%. You're right. Thank you for answering that. I really appreciate that. So you get a 25.7% more on your money by investing in the stock market at this stage we're in than if you left your money in the 10-year government bond in the 10-year treasury. So this is known as a bond, is a yield arbitrage. I posted an article of the same early this morning. Read it. Big money looks at these things. Big money says, market's cheap enough for me to buy 2.2%. I can lock in yields at 2.2%. I can buy an Apple, which the dividend yield on Apple is, I don't have the top of my head. What's the dividend yield on Apple? I'll give it to you right now. The dividend yield on Apple, if you bought Apple today, you get 2.42% on your money. How you like that? That's what just sitting and parking your butt there. So let's say you have your $10 million account, just park it in Apple, and you're going to get $200,000 a year. $240,000 a year. So Apple itself has a dividend yield. And listen to this carefully. Think outside the box, because time for babysitting is over. Think like you're in a major university class, and all of you are very educated. I know that. When it comes to the market, we all get stupid, but let's try to think like, once we were we were smart, right? I know Kartik was probably pulling like, A's in calc and statistics. All right. So Apple is giving you a yield of 2.42%, adjusted yield, effective yield, actually. Okay. So just by buying Apple, you can lock in a yield at 2.42% as of today. Now, on Friday, that number was higher. That number was more like 2.5%. So you can make 2.5% fixed interest or yield on Apple with the possibility that Apple goes up 10% over a month or 2 months, or goes up 5%. Instead, do you really want to sit at 1.7% on a 10-year yield with no chances of appreciation on your money? No. So this yield arbitrage itself means that the market short term will go higher. Now, this is not the only determinant that makes markets go higher, but it is a major determinant. Every time you see, here's a rule of the thumb, okay? Every time you see the 10-year bond dipping below 1.8 and head towards 1.7, for God's sakes, buy the frigging market. You don't need me. Because what's going to happen is you're going to have a quick, fast bounce. Now, whether or not it's going to hit this and then fall back to 1.7% again, I don't know. And even if it does, buy the market again. Because where the yield should normally lie is somewhere around 1.8%. Now, once it goes to 1.8% or so, stock market will probably go higher. So the dividend yield in the stock market will drop from 2.42 to possibly 2%. Does everyone understand that? Because remember, price and yield are inversely proportional. Does everyone understand what I just said? Okay. So if it goes to 2% and then the government bond is yielding you 1.8%, big money. The big money says, you know what? I'm going to go out there and actually go buy some bonds because I like the yield at 1.8%. I'm not going to risk the risk differential between the 10-year and stocks is only 0.2. Remember, the difference between 2 and is only 0.2. It's not worth to risk money in the stock market right now. Let me just go back in bonds. So once it reaches around this level, and you can see it's a pattern symmetry, stock markets are going to fall. Again, pull back. By that time, for this to rise to 1.82%, the S&P 500 will probably hit that 2100 level. So watch the 10-year bond. Every day, anytime you see the 10-year bond yield higher for the day, for example, today it was up 2.8%, means money came out of the bond market. When yields are higher on the 10-year bond, that means money came out of the bond market into the stock market. It's known as risk on. Doesn't mean every stock's going to be higher. It simply means money came out of the government bond market. It's actually government bond market. Okay, government bond market into the stock market. Because when the yields are going higher, that means the prices of the bonds are going lower. That means money is flowing out. Is everyone clear about that? Because when prices of something drops, that means somebody's selling it and they're bringing it into the stock market. And the fundamental reason behind that is the yield differential between 2.42 on a stock like Apple versus getting 1.75 on the bonds. End of story. I don't want to cover this too much. Now, this is one factor that drives markets. So I put that chart up there for everyone to see. Now that you understand it a little bit, and I've explained this before, and people who will be reviewing this video cast will understand it. It's another reason. Now, these are just tactical views that I showed you in the day, which are, important. If you're trading and you got some large profits, you got to take some profits at these levels. Yes, it can overshoot out a little bit higher, but it's better to be safe than sorry when it comes to intraday trading, where you could be up 30, 40, 50, 60, 70, 80%, and then all of a sudden the market pulls back and you're back to flat. Feels like shit, doesn't it? Believe me, I've been there. It doesn't feel good. And it happens very fast. So I keep on showing these levels. Regeneron, power mover, another chart. Still think the stock hits a downtrend line here at 413. It's moving between a band, between 434 and 350. Is it possible it goes back to 350? Anything is possible. Internal suggesting that it makes a move higher over the 50 and the 34-day moving average on the daily. Pretty simple chart to read once the way I draw it. Amazon didn't even play it today. Why? Because of these small moves here? It looks like it wants to get up there again towards 714 or so. But even I did call it. I did put the trade. I mean, I did say that, buy some of the calls, and they were higher. They were higher by about 40%. But it's not a major trade on my part at this level. Why? Because it was a hot stock. The hot stock was Amazon was when it was at 600, if you ask me. SPY intraday, a powerful chart. This is a inverted head and shoulder, and it held it. Here's your right shoulder, left shoulder. Here's your inverted head. And this is what we did today. When I see a red candle like that appearing, I don't sit there and sing a nice song. I tell people, if you have profits, large profits, whatever, cap out for the day on those trading stocks right there. And this is exactly off this downtrend line that I had drawn prior to it hitting it. Nowadays, I start using these markers, easier markers for people to see. I started doing this for fun. These are simple high-low candles, HLC candles, right? High-low close. Easy to see what's going on. Very mechanical. Now, after I did that, it actually went down a little bit and then moved up and closed at that 2066 level. This looks like it's going, 2060 right around here. It actually came down, created a small flag. It did this after I posted this chart. Came down a little bit, created a flag, and I did show this too. And then it broke out of the flag and went towards 2066 right here when the market broke out over 200. So, bottom line is, there's enough material that I'm putting out there. You guys need to do whatever you need to do, because at this point, I can't help anymore. So but the key to behavioral game theory is that keeping somebody's head in the correct spot, despite taking heavy blows, which we all do, believe me, okay? Believe me when I tell you. I move faster, I act quicker, and I'm determined and resilient to make every single loss back up. I've always done it in my life. I have responsibilities. I have debts to pay. I gotta do it. I don't have the luxury of moping around and crying. And neither should any of you. So saying all that, the reality of the thing is that there's some serious content being delivered. Whether or not it's a tactical bounce, whether or not it's a short trade, or anything like that. I mean, long short trades, event situations where I'm posting news and the stock starts running up like crazy. If you don't act, you will never, ever make it in this business. Your resiliency, your determination that when you wake up in the morning, whether you're a full-time trader, part-time trader, does not matter. You wake up in the morning and you tell yourself, I'm going to make the most money possible. And this is not bullshit that I'm talking about. This is the reality of the business. And I'm going to make as much money as possible today within reason. And guess what the market does? It happens to all of us. The market pulls a fast one on us. We do a trade. We try to get out. We miss it. And then for some of you, it's just like you give up for the day. And you give up for the next couple of days. Terrible. Terrible. Because the reality of the thing is that if that's the way you're going to run this business, then you are just done. Now you might say, oh, I don't have an account big enough to do this and stuff. It don't need to have an account big enough to do this. You can cash out at the end of each day if you'd like. But at least you can pick one or two trades. Let's say one doesn't go right and the other one. Remember, most of my trades go right. It's a question of how you're managing it. That's really what it is. Even in the height of the sell-off, we were doing winning trades, back to back. Earnings winners, this and that. And even intraday. You can go long or short intraday. So it's not like you have to hold things and pray that it goes the right way. Technically, something might show that it's going the right way, and then, things go a little bit off or a lot off. That's volatility. You can do small trades. But if you don't do trades, then you never get there. All right, so that's my feeling. That's not my feeling. That's the reality of the business. Now I'll take a question or two, and then I got to wrap up. Any questions? No? Okay. This consolidation channel that I keep on showing is critical. The lower end of the consolidation channel on the E-minis is, I'll put in the S&P. And I've shown this many times, but I'm telling you, this is the most critical thing that's happening in the markets right now. There. The lower end of the channel is 2030. We break 2030, all bets are off. We're going to fall very quickly. We're going to fall into the 2000 range. Okay. This is telling us from an internal standpoint that the markets want to go higher, at least for this week. However, these lines can turn very rapidly, as we saw last week. So if we do turn very rapidly and lose the 50-day moving average again at 2056 or so, because remember, the moving averages are moving averages. They're moving every day. So let's say it's 2056 and it moves right to the bottom again, 2039. Either we hold that S&P 2039, 2040, or 2038, or we break below 2030, we break below 2030, you're going to fall very quickly. Very volatile markets. I'm giving you all the guidance that people are looking for, and that's it. So that's it for now. Stay firm, focus, do something that makes you money. If you have made decent money during the day, don't give it back to the market. This market is vicious. It's always going to be vicious. The point is, don't give it back. Move away. Doesn't matter if things go higher, lower. At least you capped it. That's called profit management. Manage your own trades. All right? That's it for now. Have a great evening. I'll be putting this up on the I was going to say silver screen, on the YouTube Clueless channel. Please pass the word around. Love to see some referrals for some of you, and good night.